Hello, everybody. Welcome back to episode 35 of the Bearish podcast. This is Jared. Max and Logan are out today. They are dealing with going back to school and sports and all that fun stuff. I'm not, so I'm here. You're welcome. Let's get straight into it. Let's make it a quick, easy, digestible episode today. So this episode is going to be revolved around talks at Google. And if you don't know what that is, it's a YouTube channel there's a lot of, I don't know if you call them famous people, but well-known people, you can call them famous, well-known people that give talks at Google, on Google's campus. Very, very interesting, very, very cool. And they have their own investing section where a lot of investors or people that simply know about investing or write books about investing come and they speak to a group of people that are willing to listen, and they give their 2 cents. Very, very cool, very, very informative, and I highly recommend them. And I'm going to be talking about 3 of them in particular today. One of them is from a guy named William Green. He's written 2 books, I believe, and he just wrote one that came out early 2021 called Richer, Wiser, and Happier. The second person that we will be talking about is Jim O'Shaughnessy. He owns a investing fund, investing firm. And the third guy we will be talking about is Howard Marks. You may have heard of him. He's a legendary investor, a very, very wise guy. Warren Buffett has been quoted saying that when he gets something written from Howard Marks, he puts everything down and he reads it first. So very well respected. So yeah, let's just jump straight into it. To break it down and to make it easier for you guys and easier to follow, I broke the 3 talks down into 3 main points, okay? And what's cool about these talks is they kind of all said the same thing, but not exactly. But the things they said also went in, they like flowed into each other's or each person's talk. It was very, very interesting to hear, very, very cool. So the first point is you have to think differently in order to perform better. Second point, you have to stay disciplined and rational. And the third point, make it easy on yourself. So these guys didn't say this is how you invest, this is how you value a stock. It wasn't those kind of talks. It was, this is the mindset you have to be a great investor. William Green started off his talk talking about this guy named Peter Bernstein. And I haven't done much research on Peter Bernstein, but I do know he was a developer of the efficient market hypothesis, efficient market theory, pretty much meaning all stocks are accurately priced based on all the information out there. The markets are efficient. You can't beat the market because everything's priced in. All the information that's out there is priced into all these stocks. It's not true. Obviously, it's not true. Markets act very irrational many times. So Peter Bernstein was quoted saying, you have to take uncomfortably idiosyncratic positions in order to beat the market. And he's not wrong, but I believe the context in which he said this was to back up his efficient market theory. However, he's also not wrong in a value investing or just regular investing scenario. In order to beat the market, you can't do what everyone else is doing. By definition, if you do what everyone else is doing, you will do how everyone else has done. And the average investor frequently underperforms the market by a large margin, because something that humans do is they buy high, sell low, which is quite the opposite of what you're supposed to do. There's a saying, I asked my dad how to invest. He said, Jared, buy low, sell high. Thanks, Dad. I will take that into consideration. But it's easier said than done, right? Most investors, and this was brought up numerous times between these 3 people's talks, their speeches, most investors, or most people in general, when they invest, they act very irrational because it's either they're not educated or it's simply in their DNA. Because humans, our DNA, we're not good investors. There's a saying that the first people in the world, they heard a noise in the bush and the one that ran away survived. And those are the genes that we have today because they were passed down, obviously. So humans, in general, it's just in our DNA not be good investors, right? Because investing is kind of counterintuitive. I don't want to say supposed to, but the way to invest and the way to successful investing is you buy when things are falling, when there's maximum fear in the market. That's when you buy. You don't buy when things are skyrocketing, because you're paying, for the most part, a very high premium to intrinsic value of these businesses. Meaning you're paying much more than what these businesses are actually worth. That's not what you want to do. You want to pay less than what the business is worth in order to make a great return on your capital that you've invested. So William Green said you have to be willing to be lonely. And he's not meaning, fucking go into your room and shut the door and never talk to anybody. He's meaning in the way you think, and you have to diverge from the crowd to be successful. And the crowd is the majority of investors, the majority of people. They like I said before, they buy when things are high and they sell when things are low. Jim O'Shaughnessy in his talk said he had a client. The client would always call Jim when things were going great. The market was booming, skyrocketing, and prices were going up, 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 up. And the client would call and say, Jim, put me in the most aggressive fund you have. The market's amazing right now. Everyone's making money. I need to be in the most aggressive fund. So in other words, he was very bullish with the market, being at all-time highs or skyrocketing, as most people are, right? And Jim would say, are you sure you want to do that? Deep down, Jim knew this was probably the time to sell. And the opposite would happen when the market was crashing and stocks were falling and there was a lot of pessimism in the market. The client would call Jim back up and he would say, Jim, take me out, sell everything. I don't want to be in this market. It's going to zero. And Jim would say, are you sure you want to do that? Because in the back of his mind, Jim knows this is when you're supposed to buy. Moving on to Jim O'Shaughnessy's talk, he was very keen on explaining how we think in terms of biases. So he brought up this thing known as the recency bias. And what this is, he explained, we pay humans, people, whatever, investors, whatever. We pay the greatest attention to what has happened recently, and then we compound our error, we make it worse, with forecasting what has happened recently into the future. Meaning, we think what's happening now is going to continue to happen years and years and years into the future. That's not a very good way of thinking. For example, if you think the market is going to return 36% every single year for the rest of your life, you will be very disappointed. He said, we often forget about things that happened in the past and think right now is the only time something has ever happened. And a good example of that is people are, people started in 2020 when investing became cool for some reason. People started saying Warren Buffett was washed up, he's not good anymore, blah, 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 things of that nature. Very ignorant statements. And people think this is the only time that's happened. This is the only time Warren Buffett his techniques are not working, quote unquote, whatever. And in fact, this isn't the first time. In 1999, Barron's wrote an article titled, "What's Wrong, Warren?" And I mean, this isn't the first time this has happened. So, and in fact, Warren Buffett since 2000 has outperformed the S&P 500 60% of the time, 12 out of 20 years. And when you're considering how much money he's managing, over $300 billion, you start to think, or you have to realize that his pool of investment ideas is very limited. Choices, if you will. His pool of investment choices are very limited. If he puts $100 billion into a company that's worth, $200 billion, he just bought 50% of the company. So he has to buy very expensive companies, very big companies. So it's not very easy for him to do the 50% per year that he was consistently doing when he was managing small sums of money. Continuing, I made a point that everyone's a genius in bull markets. People think they know everything when they buy a stock and it goes up, when in reality the entire market is going up. So if you lose money in a bull market, you probably shouldn't be investing anyways. And these guys all made a very clear statement that you don't make money in bull markets, you make money in bear markets. A bear market is when the stock market is falling and there's maximum pessimism on Wall Street, everyone's selling, the sun will never shine again, things of that nature. That's when businesses and stocks get cheap. That's when the bargains show up. That's when things go on sale, and that's when you buy. Jim O'Shaughnessy also explained this example with a food truck. He said when people are, very euphoric and, they think they can sell what they own for multiples that don't even make sense. He said, think of it like this. If you're walking around and you see a food truck for sale, you go up to it because you're interested, you want to buy it. You go up to the food truck and the owner comes out and he talks to you and you ask him, well, what are you asking for it? And the guy says, I'm asking $10 million. And you're like, okay, that's a lot of money. What are your revenues? How much do you make? How much do you sell? The guy says, I sell 100,000 a year. And you're like, okay, I didn't know you were a crazy person because I'd have to wait 100 years to make my money back. So you move on. But in fact, that's what happens in the stock market lots and lots of times, because a majority of people don't see stocks as businesses. They see them as a stock certificate, if you will, an accessory that doesn't really represent the business. Far too many people think this way. It's, in my opinion, very, very ignorant to think this way and very incorrect, but people have their ways of thinking. That's fine. And just to give an example of this, Tesla's market cap to net income, which is their bottom line, which is their earnings, what the company earned, so Tesla's market cap is, as of today is Saturday, August 21st, is $670 billion. Their net income, as of 2020, last time they reported, was $721 million. When you divide those two, you get 930 years. So if you were to theoretically buy Tesla for their market cap, it would take about 1,000 years to get your money back. That doesn't sound like a good investment. This is just theoretical because I know you have to incorporate growth rates and things of that nature. So don't come at me. Relax. It was just an example, and to show you that things like this happen in the stock market. Okay, so moving over to the last talk that featured Howard Marks. I'm going to hurry up because I'm running out of time. Howard Marks says the greatness of your performance comes from not what you buy, but from what you exclude. And he went into this example of, well, when I play tennis, I don't try to hit winning shots because I'm not very good. I'm an amateur. When I play tennis, I try to avoid hitting it out of bounds. In other words, avoid losing. So he said, an easy way to be successful in investing, just eliminate half the universe and you get rid of the losers and you only focus on the winners instead of trying to pinpoint this home run hitter, this great business that nobody has seen or nobody's invested in, and it's overlooked by Wall Street because there's not many of those, if any. He said, just get rid of the losers and just focus on this pool of winners right here. Focus on this pool of great businesses that will yield you a good return on your investment. So yeah, that's a good way to think about it. It's a very beginner-friendly way to think about it. And yeah, that's about it, guys. That's all I have for you today. I try to get through it as quick as possible. I really hope you enjoyed it. This was episode 35. If you guys want us to do any episodes in the future on whatever topic that you may be interested in, drop a comment. Don't forget to follow us on our YouTube channel, our YouTube Shorts, our TikTok, and our Instagram. Everything is in our link tree that you can find in this video description or on our Instagram. Follow us everywhere. That's about it. Appreciate you guys. Thank you for listening. Love y'all. See you next time.